Why life gets easier after $10,000, but your bank hates it. Most people think the hardest part of making money is the climb to your first 100,000. They are wrong, because the moment your bank balance consistently clears $10,000, you enter a psychological and logistical trap that nobody warns you about. It is a quiet, invisible friction that turns your bank into an adversary rather than an ally. You think having money makes life simpler. In reality, it makes your relationship with financial institutions a high-stakes game of cat and mouse. Let's look at the math first. Why does life actually get easier at the $10,000 mark? It is not about the lifestyle. You aren't buying a yacht with 10 grand. You are buying the end of the emergency cycle. According to a 2023 report from the Federal Reserve, roughly 37% of American adults cannot cover a $400 emergency expense with cash. If your car transmission blows, you are forced to use a credit card at 22% interest or take out a payday loan at 300%. That is the poverty trap. You are not paying for the repair, you are paying for the privilege of being broke. Once you hit $10,000, that cycle breaks. When the unexpected bill arrives, you pay it. You don't feel the sting. You don't lose sleep. You don't pay interest. This is the first time in your life where money stops being a source of panic and starts being a tool. This is the relief threshold. It is the moment where your decision-making shifts from survival mode to optimization mode. But here is where the problem starts. Your bank is not designed for people who have money. Your bank is designed to profit from people who are desperate. When you have $200 in your account, the bank treats you like a product. They charge you a $12 monthly maintenance fee. They hit you with a $35 overdraft fee if you miscalculate a coffee purchase. They keep your money in a savings account earning 0.01% interest while they lend that same money out to others at 7%. They want you poor, stagnant, and fee-paying. When you cross that $10,000 threshold, you stop being a profit center for their junk fees and you start becoming a liability. You start asking questions. You start noticing the lack of interest. You start moving money to higher yield vehicles, and the bank hates it. In 2021, banks in the United States collected over $8 billion in overdraft and non-sufficient funds fees. That is a tax on poverty. When you no longer pay those fees, the bank's algorithm flags you. You aren't valuable anymore. You are a customer who knows how to optimize. This is why, the moment your balance stays above $10,000, you will start seeing the security friction. Have you ever tried to move $5,000 out of your own bank account to a brokerage firm or a high-yield savings account? You get a phone call, you get a fraud alert, your transfer is blocked. You spend 40 minutes on hold, explaining to a representative why you want to move your own capital. They treat you like you are the one trying to commit fraud. They put a hold on the funds. They demand notarized documents. They make the process of accessing your own wealth as painful as possible to ensure that money stays within their walls. They are effectively holding your capital hostage under the guise of customer safety. It is a psychological tactic designed to make you think, it's too much work to move my money. I'll just leave it here. Then there is the pre-approved credit trap. Once you have $10,000, your credit score usually sees a natural bump. You aren't carrying high utilization and you aren't missing payments. You become the perfect target for predatory lending. Banks start sending you offers for platinum credit cards with massive limits and low introductory rates. They aren't doing this because they like you. They are doing this because they have crunched the data. They know that if they give you a $20,000 credit limit, there is a statistically significant chance you will eventually succumb to lifestyle creep. You see the $10,000 in the bank, you see the $20,000 in credit, and suddenly your mental accounting changes. You start feeling like you have $30,000. You buy things you don't need. You finance a car upgrade. You start paying them interest again. They want you back in the cycle where they can extract their cut. Look at the history of modern banking. The transition happened in the mid-1980s. Before then, the banking model was focused on customer loyalty and relationship-based interest. After the deregulation wave of the 80s, the model shifted to fee-based revenue. Banks realized they could make more money by nickel and diming millions of small accounts than by managing the wealth of the few. If you have $10,000, you are in the danger zone. You are wealthy enough to be a target for debt, but you are not wealthy enough to have a private banker who protects your interests. You are in the middle of a squeeze. So, how do you win? How do you keep the peace of mind of having $10,000 without getting crushed by the system that hates your growth? First, you have to separate your operating account from your storage account. Never keep your primary emergency fund in the same bank that holds your debit card. Debit cards are a security nightmare. If a skimmer hits your card, that $10,000 is gone, and the bank will spend weeks investigating while you have zero access to your own money. Move that money to a standalone high-yield savings account at a completely different institution, preferably one without a physical branch. If you can't walk into the bank, they can't pressure you with sales tactics or nonsense security blocks. Second, understand the velocity of money. The bank wants your money to move slowly. They want it to sit in a low-interest checking account. You want your money to move quickly toward assets that pay you back. If your $10,000 is sitting in a traditional checking account, inflation is eating about 3 to 4% of its value every single year. You are losing $300 a year just by letting the bank hold it for you. Third, stop using the bank's credit tools as a measure of your success. Just because they offer you a massive credit limit doesn't mean you should accept it. A high credit limit is a liability if you don't have the discipline to ignore it. True financial power isn't having a bank that trusts you with debt. It's having a life where you never need to ask them for a loan in the first place. But the biggest shift is mental. When you reach that $10,000 mark, you have to stop thinking of the bank as a place where you keep your money. You have to start thinking of it as a utility, like electricity or water. You want it to be invisible and low cost. If the utility company starts sending you bills for maintenance or trying to sell you a different brand of electricity you don't need, you switch providers. The reason life gets easier after $10,000 is not because the numbers on the screen look nice. It is because you have finally built a firewall between yourself and total disaster. You have moved from playing defense to playing offense. But realize this, the system is built to punish those who get ahead. It is built to keep you in the middle, paying fees and collecting interest on debt. The moment you decide to keep your money and protect it from those fees, you are effectively declaring independence. You will be blocked, you will be questioned, you will be marketed to with increasingly aggressive tactics. They will act as if they are protecting you, when in reality, they are protecting their profit margins. It is a strange irony. The more money you save, the more you have to fight to keep it. The bank wants you to be a good, obedient, fee-paying citizen. They want you to use their high-interest cards and their low-interest savings vehicles. When you refuse, you become a problematic customer. And in the world of personal finance, being a problematic customer is usually the only way to become a wealthy one. Ask yourself, is your bank working for you, or are you just a source of revenue for them? If you haven't checked your interest rate or your fee schedule in the last 6 months, you aren't the one in control. You are just a passenger in their business model. At $10,000, you have enough leverage to move. You have enough capital to demand better terms. You have enough to walk away. But you have to be willing to be the person who shuts down the account. You have to be the person who says no to the credit card upgrade. You have to be the person who ignores the pre-approved notifications. The system relies on your inertia. It relies on the fact that opening a new account takes an hour of effort. They bank on the idea that you are too tired or too busy to move your money. $10,000 is your ticket to freedom, but only if you recognize that the bank isn't your friend. They are a vendor. And like any bad vendor, if they don't provide value, you need to fire them. Take a look at your account right now. Check how much you paid in fees last year. Check the interest rate you are earning. If you aren't happy with the numbers, do not wait for the bank to change. They won't. They love the status quo because it is profitable. You are the only one who cares about your financial future. The bank is just an entity looking to balance its books at the end of the quarter. Your $10,000 is a drop in their ocean. But to you, it is the foundation of your future. Protect it with the same intensity you used to earn it. After all, if you don't take your money seriously, why should anyone else?